That's where we'll start with James Garish from Shaw Partners and Market Matters. James, hi. Is the market telling us, at least early in its reaction to CBA's result, that this could be as good as it gets?
Yeah, good morning to you, Nadine. It's trading down 4.5% at the moment, 104.31 as I'm speaking. So, clearly there was a lot built into this number. So they've delivered a meet, but they haven't delivered a beat. And I think, perhaps the market was expecting net interest margins perhaps to be north of the 2.1. 2.1 they expected. That was up 23 basis points on the period. But as I said, it was an inline result. But nothing that would, in my view, should drive the stock higher from here. And obviously, it's a pretty crowded trade on the long side. So we're seeing some selling in the market today, and it's right across the banking space. So CBA is obviously the pin-up of the banking sector. So this, negative influence is transpiring right across the space.
All right, so let's get to Wesfarmers, shall we? Because there's been so much made about the slowing consumer. Bit different potentially from areas of the Bunnings business, that being Bunnings. And also, its foray into health, which it did talk up, in its outlook statement as being an area for growth in terms of consumer demand. So net, how do you weigh Wesfarmers, keeping in mind its conglomerate nature? Because they've also got quite a lot in there about lithium and chemicals and all the other parts of the business.
Yeah, Nadine, they do. It's a fairly diversified business. So the result today was a good one. So it was above consensus at the EBIT line by about 9% and above consensus by about 5% at the profit line. That was driven by Kmart. So you think about the consumer trading down into lower price products such as Kmart, but is also supported by the chemical, energy and fertilizer business. Bunnings was in line with expectations, but you had Catch and Officeworks, which was slightly below. But overall, it was a really strong update from Wesfarmers today, and it shows that the quality retailers are continuing to do well. And that was featured in their trading update they provided for the first 5 weeks of calendar 23, basically saying that growth is in line with the first half of 23, which is obviously a positive. We've seen a number of the retailers say that it slowed. That's not the case with Wesfarmers, and the stock it's trading up at the moment, but it should be up a reasonable amount, a couple of percent, I would say. And we've got this in our portfolios, our income focused portfolio, so it's trading up 3% above $50 at the moment, Nadine.
So you reckon there's more upside to come in Wesfarmers?
What you're going to see is that as conditions toughen in the retail space, the good retailers are going to perform. And I think this is probably a lesson for investors to understand. That not all retailers are the same. You think about Wesfarmers have got a really diversified mix across their business. Retail makes up about 80% of their earnings, so it is very much dominated in the retail space. But also, the stock's been pretty weak in the last 12 months or so. So there's not a lot of optimism built in. And then I think about their balance sheet. They've got a great balance sheet, and they're someone that can take advantage of weakness right across the retail space. So there's certainly one that we're more keen on than some of the other retailers that don't have the flexibility that Wesfarmers have.
Got it. Okay, so that is a couple of the big ones today, but I say a couple of the big ones. Also, Cochlear. So it's talking about spending on R&D and cloud investments, also talking a bit of cost pressures coming through. What do you make? Because the initial market reaction as well has been pretty positive. It's one of those companies that at least at the open of market, just checking again, trading up by more than 6%. So it reaffirmed its guidance. What's going right there at Cochlear, and what gives you confidence that perhaps it can continue to execute?
Yeah, well, they've smashed it out of the park here for first half earnings. So they did revenue of 892 million. The market was sitting at 850. That dropped down to a net profit for the half of 142. The market was at 131. So they've really beaten expectations. I would have thought that they could have, there would have been scope to increase full year guidance. So they're guiding to 390 to 305, as you made mention of. The market's at 298, so midway, the midpoint of that guidance. I would suspect that we'll see upgrades here, and that'll continue to drive the share price higher from here. So, 6% gains on open is probably a reasonable start for Cochlear, but I think we'll see upgrades to consensus, and we'll see consensus move to the top end of the guided range, given the strong momentum in the first half.
Thank you. Look, just a quick thought on Vicinity, because these are regional centers. They've got those big, real anchor tenants, I think they're called. But it's even forecasting that it will see a slowing in retail spending. So is that just sort of a harbinger of what's to come from some of those, again, consumer-related stocks, but also in the property space? We've got a lot of retail property REITs out there.
Yeah, they're all talking about a cautious outlook going forward, but Vicinity, like some of the others, have reported really strong numbers. So some of these property companies have been under a lot of pressure. The market's negative on them, expecting really bad outcomes. But Vicinity, did funds from operations of 357 million for the half. That was above 308 that the market was anticipating. So it's about a 16% beat. There was a $25 million write back from COVID-related expenses. So you strip that out, they're still beating by about 7%. The dividend was above expectations, so they've delivered a first half dividend of 5.8 cents. The market was at 5.2. So obviously they're talking about the conditions toughening, but these share prices have been belted leading into this update. So property is one of these areas, and that in some areas have been sold to down too far, in my view. Vicinity is one of those. Dexus is one that has reported recently that probably fits that bill as well, indeed.
Okay, are they in the portfolios, can I ask?
Don't have Vicinity in the portfolio, but we have Dexus in our income portfolio, and we're really positive on the result that they delivered. Mm-hmm. They're trading about a 40% discount to NTA still. So to me, that looks interesting.